Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets.
Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. This week we're going to carry on the discussion from last week's episode where we ended on Canada's CAPEX problem. We'll briefly touch on what investment or capital expenditure is, how it's distributed in Canada, how this has evolved, and why improving private CAPEX growth is the only way to arrest Canada's secular decline. Okay, so quickly for the uninitiated, what is CAPEX or investment? Or if you want to be a nerd about it, gross fixed capital formation. Terms that for our purposes are interchangeable. CAPEX or investment is the money spent to buy or maintain long-term assets like buildings, equipment, or vehicles. They are generally, but not limited to, big investments meant to help a business grow or better operate over time. This spending on things like machinery and equipment and buildings is the foundation on which the private and public sector provide goods and services. It creates jobs, improves the productivity of the labor force, and keeps the economy strong by replacing old equipment. Over time, this investment can make a country more competitive and attract foreign investment, thereby boosting long-term growth. Last year, in her seminal speech titled "Time to Break the Glass, Fixing Canada's Productivity Problem," the Deputy Bank of Canada Governor, Carolyn Rogers, emphasized that weak capital investment is a key factor in Canada's productivity emergency. She noted that Canadian businesses invest significantly less in machinery, equipment, and intellectual property products compared to their global peers. Specifically, business investment in machinery and equipment in Canada is about half that of the United States and well below the OECD average. So if Canada has been mired in a productivity emergency, how is it able to have decent top-line economic growth over the last few years? Well, at a fundamental level, the totality of economic output is the number of people multiplied by individual output, or productivity. An economy can grow even when productivity is negative if population growth jumps up to replace it, and that's exactly what we've seen over the last few years. Massive population growth via immigration is, of course, undesirable for various social reasons, and ultimately it is unsustainable. And indeed, that's what we are seeing. The only path to sustainable, long-term economic growth is steady improvements in productivity supported by investments in labor and equipment. Population growth is a sugar high. Another type of sugar high is that of credit. Yes, credit is important to fund investment in productive assets, but in Canada, as many of you probably already know, much of that credit was funneled into a speculative housing bubble, i.e. an unproductive asset. Now that the global yield curve and Canadian interest rates along with it are rising, credit expansion has slowed, and higher debt servicing costs will further weigh on credit growth. So what does this mean for Canadians? Well, population growth lifted headline figures, but that growth was fake. We've been bamboozled, really, all of us. In reality, Canada's GDP per capita has been flat for nearly a decade. This should piss every Canadian off. There has been no sustained productivity growth, and productivity growth is key to lifting economic output per person, which directly influences income, consumption, and the overall well-being of citizens, i.e. their standard of living. One more thing before we switch gears and look ahead towards the end of the decade and beyond. There are some people who will have you believe that the weakness Canada is going through is normal. You need to reject this. From 1994 to 2015, GDP per capita rose lockstep with that of the US and was in the middle of the pack for most of the OECD. This recent stagnation in the standard of living for Canadians is abnormal. And as always with these types of secular declines or stagnation, it is the poor that are hardest hit. So why are Canadians brainwashed? Besides the fake growth numbers that hide the underlying weakness in GDP per capita, it's because they are under the impression that slogans like spend less and invest more are going to cure what ails us. Now, it is my sincerely held view that governments should invest in all manner of capital goods and projects that would be impossible for the private sector to underwrite, like, for example, the Confederation Bridge or the Montreal subway system. These projects are too big and too expensive, and the government, many governments all over the world, are perfectly placed to take on that type of risk. Indeed, the chart above shows government CAPEX, dominated by non-residential construction, has grown of late, returning the top-line figure to all-time highs. This is a good thing. Unfortunately, at the end of the day, the government can only do so much. This is because of the simple reality that most of Canada's CAPEX is sourced from the private sector. Now, this is not at all abnormal, unless, of course, your country is on a war footing or you live in a command economy, which I would not recommend. It is the private sector that allocates capital. And as you can see from the chart, private capital is more than 4 times larger than that of the public sector. The next chart shows you a breakdown of the aggregate private sector CAPEX. And yes, some segments are going up, like intellectual property products, which includes software. But virtually all other segments, and again, size here matters, are on the decline. And this is true for most of the subsectors too. Machinery, equipment, electrical machinery. Even R&D is flat and actually at a 25-year low relative to GDP. And of course, due to the constant attacks from this government on the oil and gas sector, mining exploration, which is dominated by the oil industry, has also collapsed. So why is the private sector not investing? Well, we've outlined 5 major issues that have hurt the incentive to invest in Canada. And I will concede that Canada's new Prime Minister has addressed a couple of them. But here is a quick rundown in our view of what ails Canada. Number 1, regulation, like the new Impact Assessment Act, Bill C-69, and others that directly impact the oil industry, Canada's most important export. All the anti-oil rhetoric along with these regulations have crushed people's incentive to invest in Canada in these sectors and others in the natural resources. Number 2, taxes. There isn't much media coverage on this subject, but the 2017 Trump tax cut really hurt Canada's competitive advantage. Why invest in Canada with all the government overreach and regulation when you don't even get a tax break? Number 3, geography. You're familiar with the intra-provincial tariffs and the like that restrict companies from investing across provincial borders. Number 4, the housing bubble, which sucked up a lot of good money. Although this is fizzling out, this had a huge impact on investing in other parts of the economy. And number 5, the labor substitution effect. Importing cheap labor disincentivizes capital investment. And indeed, it is Canadians that listened to the signals that various governments were giving them and have sought greener pastures, specifically in America. And we can see that here in this chart as outward direct investment, the red line, has outpaced inbound investment for years now. But note that this wasn't always the case. Canada will continue to suffer a productivity emergency until we wrap our heads around that we need to incentivize and facilitate private capital expenditures. How and if we're going to do that, that remains to be seen. All right, thanks everybody for watching. Please like, subscribe, and follow for more. And as always, we manage money for families all across Canada and the world, so feel free to get in touch.